So guys, thank you so much for coming today. This is our business bites, we call them. I hope you've got your lunch or you've had lunch already. And then we can go through our topic today, which is helping businesses thrive through financial advice. Huge thank you to the lovely Joe Parker from McMillan Wealth Consultants Limited. And he's also part of St. James's Place. So he'll be talking you through the importance of financial advice when it comes to running your business. So delighted to have you as our speaker today, Joe. Thank you very much. And I will pass everyone over to you. And you're in control of the show, Joe.
Perfect. Thank you very much. Well, good afternoon, everybody. Thank you for taking time out of your day to join. And I believe this is being recorded. So if you want to watch it after to catch up, then that's absolutely fine. I'm going to take a bit of a whistle-stop tour in terms of things you can do with your business to maximize your profit and make sure that you're looking after both yourself, the company, and your employees. So I'm just going to share my screen and load up the presentation. And then if at the end you've got any questions, you're more than welcome to fire them past me. And there's a QR code as well. So if you scan the QR code, then you can find my contact details as well. So I'll just load it up. Perfect. So you should all see that, hopefully. Oh, hang on. There we go. All good. Brilliant. Great. So yeah, as I said, so this is, if you scan that QR code, you can access my details. I'll go it on the end of the slide as well, just in case you don't have time to scan. So I'm just going to change to the next slide. So a little bit of information about me. So I'm a self-employed financial advisor. I went self-employed back in July 2020. But prior to that, I've been in both the financial advising world since 2014. And prior to that, I worked for a couple of banks. So all in all, since 2009, around financial services. And I'm able to provide sort of financial education services across different companies, different co-working spaces, and obviously to yourselves today. And the areas that we'll be covering will include pensions, investing from your business, business protection, employee protection, and just a little bit about the importance of financial well-being as well. So if we start off with pensions first and foremost, so some of you may be aware there's a few different pension pots that you'll be thinking about when you come to retirement. So you've got your state pension, which is providing you're making your national insurance contributions. If you have at least 35 full qualifying years at the end, you'll be entitled to the full state pension, which is £203.85 a week. The state pension age is varied, but it tends to be around 67. They are thinking of possibly putting to 68, hence the note on the screen. Some of you may be paying into a workplace pension, or you're working for a company or own a company and are making pension contributions for your employees. So on the side of the screen, you can see some of the sort of the criteria that falls under that. And then finally, you may be wanting to put some money in yourself as well into a personal pension. So the idea behind it is that if you've got all three kind of cogs working together, then you'll be in a strong position to give yourself a really good retirement from pension products. So will your pension be enough? So the average annual pension income that a single person receives is $12,800, and then $19,900 for a couple. And as you can see, if you want a moderate retirement versus a comfortable retirement, you've got an idea of what you kind of need to build up. So if you're getting about 10 grand a year from a state pension and you were single and you wanted a moderate retirement, you might have to sort of find another £13,000 from somewhere. And that's where having a workplace pension or maybe some kind of private pension really comes into value. So what happens when you're making contributions for employees? So the minimum total contributions under current automatic enrolment rules have been set by the government, and the minimum that they'll pay is 8%. And your employer must pay in at least 3% of that. So the way it works is you've got employer pays in 3, you pay in 4, there's then tax relief that's added, which makes your 8% contribution. And there are different ways in which the pension contribution can be made. So most employers will do what's known as relief at source. You've then got the net pay method, and some of you may be doing something known as salary sacrifice, which is a very efficient way to pay into your pension. If that is an option, I'd recommend looking into that in more detail. And if you need to find out the rules, so if you've got a company, most of you, if you're employing at least one individual, then you'll be paying into a workplace pension for them unless they've opted out. So if you do need to sort of familiarize yourself with the rules, then the website's on the screen at the moment. So how does it work if you're self-employed or you want to pay into a private pension? So let's say Sarah pays in £400 a month into her pension. She automatically receives a 20% uplift for doing nothing. So she's already £100 up with tax relief. In this scenario, Sarah is also a higher rate taxpayer, so she'll be able to claim an additional 20% relief back. So theoretically, if she's then an additional rate taxpayer, then she might be able to claim an additional part back. And the overall pension contribution is therefore worth £600 a month. So you'll have £500 in your pension pot, but then you can claim an additional £100 a month back via self-assessment if you're a high rate taxpayer. So it just really shows you the value of being able to pay into a pension. If Sarah was a basic rate taxpayer, then actually she would just get the standard 20% tax relief that I mentioned. And if you are entitled to receive additional relief, then it could be paid to you as either a rebate, a reduction in tax liability, or a change to tax code. And you'll just speak to your accountant with regards to that. So it looks like a busy screen, this one, but I just want to draw your attention to the left. So if you're a limited company owner, you may be familiar with taking things like salary and dividends, but you might not necessarily be taking pension contributions. So there's an example here. If you're a high rate taxpayer and you're taking £20,000 from your business, the differences between the three. So if you look at salary, for example, after you've paid national insurance contributions, tax, if the benefit to the individual is £9,999, if you took it via dividends, then you have to pay corporation tax. There's dividends tax that you then have to pay. So you get a slightly higher amount of 10,732. Whereas what you'll see is with a pension contribution, you don't have to pay any tax on it, only at the point that you're potentially withdrawing it in the future. And in this scenario, we've used a high rate taxpayer as an example, but the benefit could be worth 14,000. So you can see pension contributions can be very valuable when paying from your business into your own pension. So it's worth speaking with your accountant about that one. If you've got profit in the business, you don't need to keep it in the company, then it's a third way of withdrawing money from your company. So what can you actually pay into a pension? So up to last tax year, it was up to £40,000 gross you can pay into a pension. It's now gone up to 60,000. So for a lot of people, that's a big allowance, and most people should be able to utilize some of that allowance efficiently. And if you are in a position where potentially you've got a higher pension pot over time, you have something known as the lifetime allowance. So effectively, you can build up to £1,073,000 worth of benefits before potentially paying tax. Some of you may be aware that this allowance has been frozen and is due to be abolished. So technically, there won't be a ceiling limit, but that is subject to potential government coming in next year. So I won't go into too much detail on that, but as you can see, you've got lots of scope to be very tax efficient with your money when paying into a pension. And with company directors' pensions, it's an allowable business expense, providing that the employer contributions passes the wholly and exclusively test. And again, you can run that past your accountant if you have any questions. So with this example, you can also carry forward. The name's a bit misleading because actually you're just using the allowances you've not used. So you're actually going backwards, but it's referred to as carry forward. The idea behind this scenario is that if you use your full £60,000 allowance in this current tax year, you can then in theory go back the past 3 tax years and utilize the other allowances, which were 40,000 back at the time. And what you can see is that if you've made, for example, 15, 25 and 30 over the last 3 tax years, you've then got some of your allowance left over and you've got the opportunity again to make additional contributions. So let's say you had a really strong year, you've got lots of profit in your business, carry forward might be something that you need to explore to, 1, maximize your profit and move it into your personal name, but 2, save yourself from corporation tax as well. So what do you want from retirement? So by 2050, nearly 1 in 4 of us will be age 65 or over. There's 15,000 centenarians back in 2020. So you can see it's an aging population. The rule of thumb on the right-hand side of your screen. So if you're looking for a £20,000 income, if you multiply that by 25, it gives you a hypothetical pot value to work from. So for example, if you've got a state pension of 10 grand, let's say, you might only need to fund £10,000 per annum. So you would do 10,000 times by 25, and it just gives you an idea of a potential pot size that you need to aim for. And then obviously that type of conversation will then come down to, for example, myself as a financial advisor and with the help of your accountant as well. So when it comes to investing, some of you might have surplus cash in your business. So you may have a situation where you've got money in the business, you can't quite take it out, but you don't necessarily have a need for the money. So some of you might have noticed that when your money sits in your business account, it's not doing a huge deal. You could potentially be losing value of your money because of inflation. You might be receiving a very low interest rate, if any interest whatsoever. And the damaging impact of inflation is that if you're basically got £10,000 worth of money back in 2002, in February 2023, it's worth £5,904. So it just shows you how powerful inflation can be. And if you're not doing anything with your money, whilst you're not technically losing money or putting it at risk in an investment, you are losing the buying power of your money. So it's really important to think about, is your cash doing enough to make it work harder? And if you look at the chart that's on the screen at the moment, I've picked some indices that hopefully some of you will be familiar with. So you might be familiar with the FTSE 100, the S&P 500. The idea behind this is if you look at the Bank of England base rate, which is the flat pink line at the bottom, you can see the investment return and how it's generated over that long time. So this is over a 10-year period. And whilst, as you can see, there is potential risk because your money will go up as well as down, over the last 10 years, it has provided a higher positive return than keeping your money in cash. But it's really important you've got the capacity for loss when it comes to investing your money. So if you need your money in the short to medium term, you shouldn't be thinking about investing your money in your company. But if you are sitting on a pot of cash that you think you're not going to need, but you just can't quite take it out of the business, or you don't want to take it out of the business, then you want to be thinking about investing some of that money. So a possible solution is to look to invest some of that money that's held in your deposit account for the medium to long term. There were some changes to corporate accounting basis whereby the company effectively valued the investment annually. And then what was happening is you had to pay corporation tax on the investment. But we actually have a solution where you basically invest the money. You don't have to pay any corporation tax until fully or partially encashing the investment at time. So the idea behind it is that we're offering a solution to help hopefully grow your money over the long time, think about those inflation issues and putting your money to harder work. Because I think business accounts tend to get quite neglected. That money's not necessarily been taken out. And when you're paying corporation tax as well, you want to make sure you're making your money work hard for you. So the idea is that providing you don't have a debt-based investment, so as long as you don't have too much corporate borrowing within your investment and you go things like stocks and shares, so investing in companies, we'll be able to look at a solution that will allow you to invest your money and you don't have to worry about corporation tax while you're investing. So some of you might be thinking about business protection. So it's making sure that not only yourself is protected through the business, but you're thinking about your employees as well. So I'll come on to employee benefits in a moment. But as you can see, there's sort of three other areas where you may want to look at additional protection. So you've got business loan protection, profit protection, and business succession planning. So if we take business loan protection as an example, so your business might have some form of debt. So it could be overdrafts, loans, mortgages. Maybe you've got a director's loan on the business. And for example, if you was to die or to have a serious illness, or someone else in your business was to have a serious illness, it could potentially impact your cash flow because you're having to think about paying this debt. And because you're in a situation where you might not be around or you might be seriously ill, you can't necessarily afford to maintain that debt. So some of you might have life cover or critical illness cover for your personal mortgage. So think of it a bit like that. Effectively, you're taking out an insurance to cover you, that if something was to happen to you, then effectively you'd have an amount payout in order to clear off the business loans or debt that you have in place. You've also got profit protection, also known as key persons allowance insurance. So if you've got a key staff member who really drives your business forward, that could be you as the director. You might have a salesperson that's very pivotal to your business continuing to thrive, but something happens to them. So maybe they were to die or suffer a serious illness like cancer, heart attack, stroke. Your business could again be detrimentally affected by that. And what we'd want to make sure is that you've got some kind of protection to come in. So if you were to insure someone, for example, then that money could be used to maybe hiring someone else that could replace them whilst they're hopefully recovering. Or obviously, if they've passed away, then you might need that money to find someone else to invest in. And last but not least, in terms of business succession planning, so you can have a few issues around if for example, one of the directors or the shareholders was to pass away. You might not want to have their family coming in and running the shares, or they might not have an interest in the business. So you might need some kind of cash lump sum to effectively pay out the family members that would effectively be taking on the shares, so that they can then be distributed to people in the business that can run the company. Because if, you know, one of the directors was to pass away, or one of the company owners was to pass away, then it could again be detrimental to the business running on a day-to-day basis, and therefore affecting your business. So it's really important to just think about what types of protection you can put in place if the worst was to happen. And there's other things to think about, like loss of capacity. So if you were in a position where you couldn't manage your business anymore, you can't manage your financial affairs due to health, then you want to make sure you're thinking about who you could effectively trust to look after you if the worst was to happen. So it's who you would sort of trust to run your business. Maybe look at your personal financial affairs. So something like a power of attorney is a really strong document, which you should think about putting in place. It's not something that I do personally, but it runs with finances quite well. And it's a legal document to make sure that you can leave someone in charge of your, you know, really important decisions like financial and health decisions. Some of you might be familiar with a will as well. So the idea behind a will was to have a legal document in place to determine where your money is going to be left if the worst was to happen to you. And in some cases, you might have some money which you want to sort of put away, but you don't want it to be accessed until a certain period of time. And trusts will come into play with regards to that. So it's about thinking about your future in terms of, okay, if you wasn't around, what levels of cover and what levels of documentation do you have in place to make sure your business continues to run? In terms of employee protection, so I think a lot of people think about their staff in terms of giving them a good salary, but you know, it's always the case that salary is the main driver for someone. So you'll have some larger companies that will offer things like private medical insurance, death in service, which is effectively life cover for your employees, maybe better sick pay, better holidays, making sure that they've got the right contributions in place for their pension. So it's really important to sort of open your eyes in terms of what other areas of protection, what other areas of perks could you give your employees should you have some. So for example, with statutory sick pay, your employees may be eligible for that, but it's only £109.40 per week up to 28 weeks. And then after that, they would then go through potential benefits assessments. Now, as an employer, you don't maybe necessarily want to have the burden of an employee being out of work, because you might have to pay them if you've offered them sick pay. But at the same time, you've got, I guess, a moral obligation to make sure that they are okay and you're not just leaving them to suffer financial difficulty. So this is where income protection insurance comes into play, because you could potentially take out a policy that would allow your employees to have some kind of income protection. And that can be for the directors and the owners as well. You then got life insurance. So again, that's back to the death in service. So it's allowing some kind of income multiple to be paid out to their loved ones if something was to happen to them. So for example, you might want a policy of 4 or 5 times a basic salary to be paid out in the event of them passing away, which would then be nominated to their family or whoever they choose. And critical illness effectively works in the same way as life insurance. So it's about making some kind of income multiple if someone was to have a serious illness. And potentially the products that we've just been discussing are potentially allowable as a business expense, so could enjoy corporation tax relief. So for playing your part on offering additional work perks, there might be a possible tax saving for you as well. But effectively, there's 3 types of sort of insurances that you could consider. And as I mentioned to you, there's also private medical insurance as well. So if you think of companies like Bupa, for example, it's sort of skipping, you know, the sort of the NHS/GP route and trying to get sort of that private cover as well. And then just a final part on financial well-being. So it's really important that your employees do get financial education and are aware of the best ways that they can manage their money. 40% of UK's employees have said financial concerns were their biggest worry in 2022. And 24% of UK employees worry about money every day. So you might have someone, if you've got staff in your office that turn up to work, but their mind might not be on the job in hand. They might be thinking about, how am I going to pay my bills this month? I need to get down to the bank and answer a query because I can't get through on the phone. So you might have someone that's physically attended work, but might not be in a position to work to their best because they're too busy thinking about financial worries. And you've got so many different generations to think about now. So on your screen at the moment, you'll see some of the different generations that you personally might fall into, or some of your staff might fall into. And these generations are going to have different needs to different people. So you're in this sort of position now where not only are you juggling and making sure that you're offering the right employment opportunities for your staff, but they're going to have different needs and wants that you're going to have to try and accommodate. You've also got something now known as the sandwich generation, where you've got people in the middle that are funding the care for potentially their parents and grandparents, but also having to think about their children and grandchildren. So whether that's education costs or making sure they've got a roof over their head. So not only is the sandwich generation having to make sure that they're okay financially, they might then have to support people on either side of their generation as well. So it's a really unique time at the moment where you have got people that are lasting longer in life. And then obviously you've then got the other side where you've got other people that are younger than you, and you've got to somehow try and balance this. So what could be some of the things that your employees are thinking about? So actually they might be thinking about the rising living costs. There might be some kind of social media influence. I'm sure we've all been through, reels and TikTok videos where people are living quite a luxurious life and it looks like that everything in the world is rosy. But the truth is most people might not be able to kind of get to that type of lifestyle. But if you're seeing it on a daily basis, they might be trying to find ways and how they can do that. Maybe they're building up short-term debt to try and to get to that point. Everyone wants something now and immediate. Gone the days of where you used to save up for something and then buy it. It's very common for people to take out short-term debt to try and get the product they want. I'm sure some of you are familiar with Klarna, for example, where you can pay for clothes over 3-4 months installments, which is crazy, really, that it's gone from buying a product individually to then spreading out, regular things. And accessibility driving consumption. So it's about, again, you're sort of got this world in front of you where you think that people are living this life, and you also want to potentially replicate that to sort of hold up a social media presence. So one of the things that I do through St. James's Place is offer financial wellbeing solutions. So I come into workplaces and I give an extended talk on things like how to manage your money, what are the different things that are going to come up during your life, your working life. And we effectively do workshops and one-to-one bespoke sessions where appropriate. And again, it's just making sure that your employees have the tools to make sure they feel comfortable with managing their finances. So that's just sort of a whistle-stop tour of some of the things that might come up within your business. I appreciate that, half an hour is not a huge time to go through things. So feel free to scan the code, my contact details on the screen as well. So if you've got any questions you'd like to take offline, I can be much more specific to your individual circumstances as well as your business. But hopefully it just gives you some information to think about around some of the ways that you can make your business thrive through the power of financial advice. Thank you very much.
Amazing, thank you, Joe. Or does anyone have any questions now for Joe, as you've got the opportunity? No?
Easy day for me then. Or I explained everything really well. So
well, you did. I was going to say that, Joe, because what you're explaining is a little bit mind-boggling, but yeah, the way you explained that and your slides as well, really, really fantastic. So thank you very, very much.
You're welcome.
This presentation is being recorded. In probably not tomorrow, but maybe the day, but by the following day, it will be on the website so that you could run through what Joe was saying, which is really handy. And then if you've got any questions, then feel free to contact Joe or ourselves here at the chamber, and we can forward on your details to him. Definitely.
Do you have a question, Lucy? So the little hand go up.
Oh, it's okay.
No, okay, fine.
My only question was in terms of some of the kind of pension elements that you kind of were putting together.
Yeah.
Is part of your service to be able to help when you've worked with tons of different employers, or you have staff that have worked with tons of different employers, there's that moment where you kind of go, I've got pots somewhere all over the place. And I think that the way that we my parents worked is quite different to the way my career is. You know, they had 40 years in the same organization, they knew where their pension was, they were lucky enough they had one. Is that a service that you would do for individuals, but also as part of your kind of business offer?
Yeah, absolutely, Lucy. Yeah, so the idea behind it is, I haven't got the exact stat to hand, I wish I did now, but there's basically, people tend to work an average of so many jobs in their lifetime, and it is, you know, quite high, 6, 7, 8. And as you know, now that there's auto enrollment in place, people are going to these companies, maybe building up a few years worth of contributions, moving on to the next one. The analogy that I tend to use for that is, if you're working, let's say you work for B&Q, for example, so they're paying into a pension pot for you, and you've got 2 taps running. So you've got your employer tap, so the employer's paying in, you know, that 3% that I was telling you about, and then the employee taps then coming on. So you're filling up this pot of money that's then invested in the market. So if you then left that company, the taps get turned off, so the contributions stop, but you still got this pot of money that's working for you. Now, you might go 10, 20, 30 years down the line without ever checking that. So then it's about, okay, well, where are you invested? Why are you invested like that? You might be targeted to a certain date that's not appropriate for you. So what you could potentially do is consolidate your pensions into one place, have that one plan moving you forward, maybe make extra contributions. It's important to note that's not right for everyone, because some older pension pots might have certain guarantees or valuable benefits, or if they could be really cheap. So you don't want to just move it for convenience, but it's definitely a conversation to have.
Yeah, my first ever pension pot is a final salary contribution.
Exactly.
And
yeah,
I have been told by everybody, don't you dare ever touch that thing, just leave it where it is.
Yeah,
but yeah, no, that's absolutely fine. So that's useful, because I think that's something that's going to come up more and more. Financial kind of well-being is, actually, I may have 20 pots that I've lost track of. How do I find them? How do I get to them? What can I do with them? All of that is a definite consideration. No, brilliant.
You're welcome.
Thank you.
You're welcome.
That's a good question, Lucy, actually, because I think I've got pots running around everywhere as well. So
I'm
sort
pretty
that
lucky,
out,
I know, but it's starting to be more than I kind of keep track of.
Yeah.
Yeah, all that paperwork, nightmare.
Absolutely. So good.
Excellent.
Very interesting.
Anyone else, as we've started with the question time? No, brilliant. Right, well, Joe, thank you again.
You're welcome.
It was fantastic to see you and to see everyone else. And as I said, you know, if you do need to contact Joe, then please get in contact with the chamber as well. My name is Victoria Galvin, and I'm more than happy to pass on your details to Joe if you do have anything moving forward. But yes, wishing you a wonderful, wonderful day, and see you next time at Business Bites. Thank you so much.
Take care, everyone. Thanks for your time.
Bye.